So another misunderstanding or misconception is that 100% reserve banking wouldn't even work, right? That banks couldn't even exist in a system like that. And I've even heard professional economists, when they first encounter the idea that, oh my gosh, there's some Rothbardians out there who are in favor of 100% reserve banking, and they recoil and say, what? That's how banks work. How else would a bank make money? So let me make sure you see where they're coming from first before I show why this isn't correct, this objection. So the idea is, you go to a bank and you give them $1,000, it's in your checking account, and they're paying you interest on that, a paltry rate, especially in modern times, but recent times. But they give you an interest rate, and then if the bank isn't going to take that money and lend it out to someone at a higher interest rate and earn that spread, how can the bank stay in business, right? How could checking accounts even be possible? How are they making money? If how are they going to pay you, right? So that's the objection. They're thinking that's how banks work. They're credit intermediaries. What are you talking about? 100% reserve banking? That doesn't even make any sense. All right, that's like saying McDonald's, can't charge you more than they pay for their resources or something. How's that possible? So there's two distinct functions that commercial banks serve, and you have to keep them at least conceptually distinct to see how this is possible. So the reason there's confusion is that in our modern environment with fractional reserve banking, where the legal system's fine with it and so on, that it gets blurry. But there's two distinct functions. So the first one is that banks could have demand deposits that they're offering to customers. So that term demand means your money can be returned to you upon demand. That's what it means. And the point of that would be for convenience or safety, right? That you have, let's say you got $10,000 in currency. That's risky just to keep on your person or even in your house in a safe. There could be a fire, somebody could break in. And so that's one function that the bank serves for the community, is they have much more secure vaults, they have insurance, they have armed guards and blah, blah, blah. And so you can go ahead and put your money there. It's just a safer place to keep it. And then there's also the convenience that they have an ATM network around the world. They have agreements with restaurants and whatever, merchants. And so just with your bank card, you can either go to an ATM and get cash all over the place, or you can just be somewhere and swipe your card, right? So it's just an easy way to keep track of where your money is being held in your name so you can spend it in a very convenient fashion. Okay, so, and by the way, that's why I'm actually not calling this a warehouse right here, because it's actually better than a warehouse, or it's doing more than a mere warehouse does, right? If you put grain in a silo or something, it's not that you can go all over the world and get a machine that spits out grain, right? And so you can see how what banks do with demand deposits is actually goes beyond what the term warehouse might suggest. Okay, the other distinct conceptual function is time deposits for credit intermediation, right? So banks do also act as credit intermediaries. And think of this as a savings account or like a certificate of deposit, a CD. That's what that stands for. If you heard of banks, selling CDs with certain associated interest rates or yields. Okay, so here you might go to the bank, you've got $1,000 that you want to lend out and earn interest on. So you go to the bank, you buy a $1,000 CD, and what that says is the bank's promising you, obviously I'm just making these numbers up, they'll say in 12 months' time, the bearer of this note, this CD, redeems it and gets $1,050. Okay, so there's the implied 5% interest rate on that for the 1-year loan. And then they take the $1,000 and they go lend it to somebody else, presumably for more than 5% a year. And so there's where the bank's earning the spread, and that's where the bank is connecting the savers and the borrowers, right? Because this, again, is a genuine social function that you've got in society. You've got a bunch of people who want to borrow money, like a young couple. They both have good jobs, so they know they have a future income stream, but they want to buy a $300,000 house right now. They don't have $300,000 right now, but they, over time, have plenty of income coming in, they think. And then you've got thousands of people in the community who want to save, $50, $100 a month, let's say, and put it somewhere where it's going to earn interest. It would be a huge coordination problem for those thousands of little savers to all pool their money to give a mortgage to that one couple. Besides just them all coordinating, it would be very risky. If that one couple, if they lose their jobs and default on that loan, all those people lose all their savings, or a portion of them. Okay, and so that's where the bank is the middleman, if you will. So all the savers in the community can put their funds with the bank. It's very safe, and then the bank makes a bunch of mortgage loans and other business loans and so forth to other borrowers. And the bank has credit officers, credit officials, who ostensibly at least are good at assessing risk and so on and charging the appropriate interest rate and so forth. Okay, so that's the textbook function of a bank serving as a credit intermediary. And obviously other financial institutions do similar things. It's not just commercial banks, but a commercial bank could do that. So those are distinct things. And under 100% reserves, banks would have to charge for their warehouse services just like other storage facilities. Okay, so that's the answer when people say, how could a bank make money if it's not engaging in fractional reserve banking? Well, if we're talking about the time deposits, so notice the thing with the $1,000 buying the $1,000 CD, you don't have access to that money for the year. If you need cash, you can go sell the CD the open market. You might find someone else in the community who's willing to pay you money, but there's no guarantee, and it's not that the bank gives you the money, right? The bank is saying when they issue that CD and the numbers I dreamed up, they're saying we are taking this money you're giving us. It's our money now. You're lending it to us. We just owe you payback in a year if it's a certain interest rate. Okay, whereas with a demand deposit, the deal is you're giving us this money and you can show up whenever you want and we'll give it to you. All right, so my point is in that first scenario, yeah, the bank would have to make its money somehow, but that's not impossible. It's very convenient to have checking accounts, and people would be willing to pay for that, right? We don't know how they would do it. Maybe the bank would say every time you use a check or swipe your debit card, we charge you 50 cents or something. Who knows? Maybe they charge you a percentage up to a ceiling. Maybe they would just charge you an annual fee so long as you didn't use it, or, a certain number of times. Who knows? But like right now, people pay fees to use an ATM, or if you use an ATM that's not your bank's ATM, you pay a little fee. It's right. Imagine someone saying, "Oh, ATMs wouldn't work because you'd have to pay money to get your own money back." People wouldn't stand for that. That's crazy. No, if it's a very convenient thing, people pay for it. That's how markets work. Okay.